Hey guys, so I'm finally doing my hedging video. As always, I'm not a financial advisor. This is not financial advice. I'm just sharing my thoughts on options trading and my journey. But yeah, we're going to talk about hedging because Monday of last week there was a crazy day in the options market, and now it's been about a week. So that data has finally showed up in Thinkorswim on demand. So we can bring up the, as if we're live. It's here. It is 9:31 that day, and say, okay, like what did the market look like? You can see here, like the VIX has spiked as high as 65, and it's come back down to 55 here. If you're not familiar with the VIX, it is the implied volatility of the S&P, right? So if I jump over to SPY, um, right, that one is showing actually 40, um, but IV is kind of like a hurricane scale for the market, right? Like you've got a Category 5 hurricane or something. Um, the IV number is a numerical score of how much demand is there for options. Right? That's price pressure, and as a result, option prices are going to be a lot higher. And when option prices are higher, since we sold options beforehand, that's bad for us, right? It's like a short squeeze on the options market. So that's kind of where we're at. So we've got kind of two problems. One problem is the market has gone down, but that's not really the end of the world. And then the bigger problem for undefined risk trades is this huge spike in IV. Now I can also pop into the Thursday beforehand. So this is close to the close on Thursday. Everything was pretty normal. We'd had a bit of chop. People were a little bit nervous, but still volatility was down around 17, right? Not 65. Or even the 42. Um, so everything was pretty normal. And what I could do, because I'm using on-demand mode, is I can go and say, oh, okay, well, what happens if I put on a put credit spread? So I went and did a 50 DTE put credit spread in SPY. I did $10 wide, and I targeted 50 cents. I ended up with 58 cents, so it's a $58 credit. And I've got a structure like this. So this is kind of what I talk about doing in the beginner friendly videos, for example, right? And defined risk trades like this are kind of pre-hedged, right? They have that long there. The most I can lose in this is $942. I'm trying to make basically 4%, right? And that's all fine. Like it just can't get any worse than that. My stop loss on this, I recommend using double the credit. So I would be getting out if I was down about $116, right? But I could lose 942. Now, some people prefer to trade these put credit spreads closer to the market, and then their credit's a lot higher, and then maybe they don't have a stop loss, right? They collect a third of the width, they'll say, right? So their max loss on the defined risk part is just double the credit. So there's no stop loss. There's nothing you need to do. You're protected. It's going to be a lot bumpier of a ride. I don't prefer to do that, but you totally can. And that's one way you could hedge even more aggressively. Still, like how bad does this get, right? Let's take a look. So we'll jump over to Monday at 9:31, right after the open. Things are an absolute mess in the options market. We've gapped down. IV is way up. Max loss, stop loss of $116, but we're down $145. That's pretty okay, honestly. Like, I just take the hit, right? Like, if this is what a really bad day looks like, then, so be it. We're not really that much beyond what our originally planned stop loss was. Theta's also gone negative, so I wouldn't stay in the trade anyway for that reason. But yeah, so I'm just going to show these in SPY, so my analyze tab isn't a nightmare. So using SPY, one thing we can do is we can just buy like a 2 delta put. It's a very simple way of hedging. Is we could just say, hey, look, I expect to make about this money per month. So like maybe every month I'm putting on a roughly 60 DTE low delta put, and then I'm pulling it off when it's decayed down to 30 days. I pull it off to recoup some of that money, and then I buy the next 2 delta 60 DTE put, and I just keep rolling that cycle over and over. So one trader I really like is this David Sun guy. He's got a podcast called The Trade Busters. I highly recommend it. He has something he calls the Trinity system. He talks a lot about hedging. That's kind of in line with the approach that he tends to take. Right, we get a huge move down, and everything is great. Now the other thing that we can do is a put back ratio. So I've shown ratio spreads as an income trade, but you can actually flip it around. And if we go out to this low delta, maybe we'll just do like a $10 wide. So I'm going to buy two of these. I'll go 1 by 2, but you could do 1 by 3, right? You could do 3 by 7. Um, Ratios are pretty open-ended. I'm just going to go $10 wide. So 420, I'm going to sell a 430. Right? So we paid for this one, but out in here, we're net long one put. Like both of these are net long one put if we're out here somewhere. But the difference is we only had to pay $48 for the ratio spread to be long that put at the expense of the market having to go down a bit more before it really kicks in. Whereas the put by itself is 57. And like I said, you can play around with these ratio spreads and do things in kind of different ways. They tend to have more VOMA, they have more ramp up in a Vega spike compared to the amount of money that you put on, right? So the other thing I mentioned was we're really trying to hedge mostly against the volatility spike, right? When it's spiking up to 65, 85, whatever. If we're in an undefined risk trade, that can be kind of the real nightmare scenario. And that's what hurt a lot of people on Monday. So there's a couple things we can do. We can buy a VIX call. It's like, so we could just buy like an at the money, or maybe I'll just do like 19. So, and you could just have some budget where, maybe at 60 DTE you buy a VIX call at the money, or however many you have a budget for. And then when it gets down to 30 days, you sell that one, and then you buy the next 60 day, right? And so on, right? So here's that one. It's kind of near the money, right? Now, the other thing that you could do is you could say, look, I'm actually specifically worried about VIX over 40, right? Like if volatility spikes, I'm mostly just concerned about what happens when it spikes past 40. When VIX is popping up to 25, 30, 35 even, then it's like, okay, maybe that's fine. It's these crazy moves like Monday where it went to 65 plus that I'm really worried about. So maybe I'll just buy the 40 strike VIX call, right? You can do that. It's going to be a lot cheaper. So you could buy 4 times as much protection over that 40 level, and that can make a huge difference. So that's an option. And we did see VIX spike up over 60, right? The other thing you can do is say, okay, I want to get as much protection as I can in a range from 40 to 60. And by the time we're at 60, I'm assuming that I'm going to be like managing positions in some way. So I'll do a debit spread, a call debit spread between buying the 40 and then selling the 60. So I get this spike in profit. It only costs me half as much. And so that the appeal of this is it only costs half as much. I don't really like this as much, but I tried all 3 of these, and I also looked at the long put 2 delta, and I looked at the 1 by 2 ratio, but I used SPX instead of the SPY that I was showing, and I took a look at how all of those performed in the crash. Okay, so what I did was I took a couple of different strategies that we've talked about, and a couple of the hedging ideas that we just talked about, and I put them into the Thinkorswim on-demand mode, entering on Thursday at 3:45 p.m. shortly before the close. Market's relatively calm, and then I came back Monday morning at 9:31 and just asked, so what happened, right? That was kind of the doomsday moment. And so these first 2 are put credit spreads, kind of like my beginner-friendly strategy, but I'm using SPX. So these are 100 wide in SPX. September is what I would have normally done per that, how I described doing those. October I just did because the rest of these are all October trades, and I wanted something a little apples to apples. But your theta gets crushed when you go out that far on these put credit spreads. So maybe you'd want to bring it closer in or something, right? So yeah, anyway, that's what I did. And I just tracked, this was the theta of all these trades on Thursday when I entered them. Vega is the sensitivity to spikes and implied volatility. According to the model, reality will be, different. And I marked down what the entry price was. But the biggie is what was the drawdown Monday at 9:31. So this is how much money I lost on each of these, but I haven't normalized like on margin or anything like that. And it's kind of hard to do when you have undefined risk trades in the mix as well. I thought would be more interesting to look at what was the drawdown on Monday compared to how much theta does the trade bring in, right? So if I'm collecting, 40 theta on an iron condor versus 8 theta on the put credit spread, um, then really I would need 5 times more put credit spreads to match that, right? So I would have 5 times the drawdown, um, and in that case, the iron condor wins out. So that's this column. And so for me, the takeaway, now in a runaway up market, these put credit spreads do great, right? So I don't want to dog on them too badly. They're good for bull markets. Iron condors really struggle in especially a strong bull market. But generally speaking, the iron condor, right? And then this was 16 delta, 8 delta. Um, the broken wing butterfly rhino version, I did a 50, 35, 20 delta like I described in my rhino video, but just like I was doing an initial one, right? And then the net zero, I used a 60, 40, 20 delta. And to be clear, I've never taken the net zero course that SMB Capital offers. I'm not sharing anything here that, and maybe they have some special, I don't know, right? But this is just 60, 40, 20 delta broken butterfly. And then the ratio spread was selling 3 5 delta puts and buying 1 8 delta put, right? Like I've talked about. And so on a drawdown to theta level, the delta neutral risk defined structures all do fantastic in terms of drawdown per theta. So I find that super appealing. Um, if you were in these, it would have sucked. You would have been down if you went all in just on these and you were doing $1 of theta per $1,000 in the account, right? You weren't spreading it across different kinds of underlyings like gold or anything like that. Maybe you were down, 8% or something, which sucks, but it's actually not that bad compared to what other people went through. So, and that's without hedging. And so maybe you don't even bother hedging with stuff that's risk defined. But here's what the hedges did. So long put, and I looked at how much theta drag these had, right? Because we're buying a put, so there's theta drag. That's going to hurt the theta that you have coming in. And so that's kind of the cost of being in these hedges. And I also included the actual entry price. But in this case, these are being entered at 50 DTE because that's kind of the closest. I put down Vega for these, but I didn't bother with the VIX stuff because that would have been VIX Vega, which is a completely different Vega than SPX Vega, so not that useful. And SPXS obviously doesn't have any theta or Vega. So of these, then I looked at what the return was compared to that theta drag, right? So to me, this is kind of the downside of being in one of these. And it's fine for the long put and put back ratio. If the return for theta here is bigger than the drawdown per theta up here, then these gave you in this instance the opportunity to hedge one of those positions without obliterating the theta, right? The higher this is, the more bang for your buck you got. You could get a decent hedge in this crash move without sacrificing a lot of theta. Now this is obviously a crash scenario. If the market is running off to the upside, you're not making any money on these. There is no return. I thought it was interesting how well the at the money VIX call did compared to things like the puts and putback ratio. And the VIX 40 call doesn't do as well on a return per theta, but I kind of like the VIX 40 call because I like the idea that that's really the scenario I'm trying to protect against when VIX blows up past 40. And this is around the open when VIX had dropped back down to like 45 or something, but right off the open and pre-market and futures options, you could see VIX blow up to 65. So even though this looks better for the 931 time that I'm able to bring up in on demand, thinking about that 65 kind of blow off top in the VIX that was super fast. What if it hung around up there? I'd rather be in these VIX 40 calls, right? And the 4060, I just don't like that it caps it at 60 because we've seen like COVID, it went up to like 85. I prefer the just open-ended protection, even though this one is kind of half price for that portion of the range. So arguably, up to 80, maybe you're still pretty happy, but I'd rather just have this one. SPS XPXS I don't like because, for example, if I look at this ratio, which is kind of the big loser here, if I wanted to hedge off a third of this loss, just be like, I want to have a hedge on that would have knocked this down by 30%. Then when you do the math out, it ends up that you would have needed about 150,000 short delta of SPY worth of SPS excess, right? It would be like sitting on a negative $150,000 position on the S&P. So the other thing that I also just want to mention while we're throwing this stuff up, like this is SPX. I had positions on in gold, oil, the British pound, euros, soybeans, a bunch of stuff. And they didn't get hit pretty much at all by this, or negligible. They were very liquid, the pricing was very stable. I ended up closing those out to free up buying power. But if you only put, let's say, 1/3 of your options trading into something like S&P options, then when your account has a drawdown, it's going to be 1/3 of the drawdown of somebody who's like an all-in everything in S&P trader, right? So definitely diversify, and diversifying doesn't mean you're trading iron condors in like Nvidia and Tesla, right, and Apple. I really mean looking at things like GLD, USO, EWZ, which is Brazil. If you're doing like smaller stuff, or for futures options, you've got CL for oil, you've got GC for gold. Just take a look at that. There's a book by Andrew Falde called Skip the Dip that I would definitely take a look at that talks about that. But yeah, that's just like another, and that's a free hedge. Diversification is the one sort of free lunch in the trading world. So just keep that in mind. Okay, so I had an earlier video on the Monday IV spike. YouTube decided to share it with a ton of people, I think because I was in Dumageddon. And that drew in a lot of toxic people who dumped on the comments. Some of them went through my other videos just to downvote them. Now, YouTube doesn't pay me. I'm not selling a course or a membership. I don't have affiliate links. I just do this for fun. And having morons pile in with their, I make 1,000% a year with no risk, or pumping their shitcoin, is not fun. One person said some nasty things about the Philippines and Filipinas specifically, and I love this country. I love the people here. If I start seeing that kind of shit again, I'm just going to lock comments completely. So if you can't comment, I'm sorry, but that's why. I've covered all the main option topics that I was thinking to do, so I don't know what I'm going to do going forward. I had been thinking to do more Philippine stuff, but honestly, after that experience, I may just wrap this up here. If I don't come back, I wish you all luck in life and trading. I'm grateful for all of you following me along my journey so far. And if you haven't been to the Philippines, I highly recommend it. Truly the nicest beaches on earth. And in that case, then this will just end up being goodbye. So, peace.